Hello and welcome. Good morning. You're watching Bloomberg Quint, India's first digital live streaming business news service. I'm Devina Khanna and you're watching Indian Open. Let's go straight to the headlines. Prime Minister Modi endorses Donald Trump for a second term as US President at the gala event held in Houston last night. Petronet signs a $7.5 billion pact to buy 18% stake in Tellurian's Driftwood LNG terminal in Louisiana and negotiate a purchase of 5 million tons of gas per annum. Care Ratings downgrades Reliance Capital's debt worth $5 billion to default. Finance Minister Nirmala Sitharaman says the government will evaluate the fiscal position closer to the next budget, even as Moody's warns of fiscal slippage post-corporate tax cuts. The GST Council lowers rates on premium hotel properties, taxes hiked on caffeinated drinks. All right, back to the markets then, and a quick look at the setup for this morning's trade. Going back to the U.S. equity markets in terms of the kind of moves that they had, you've got the Dow Jones as well as the S&P 500 and Nasdaq trading with cuts of about almost 1%, 0.5% to almost 1%. And by the time they closed shop, it was a day in the red. And this also on the back of some pessimism that's coming back in terms of the trade deal talks. We'll come to that in a bit. But Asia as a pocket is also trailing what the U.S. markets are doing. Hang Seng and Shanghai are trading with cuts, 1% lower for Shanghai, Hang Seng trading under by 0.25%. But the only bright spot in that Asian screen is the SGX Nifty, which has got gains of about 1.5%. So 164 odd points at the start of the trading session, already surpassed 11,500 on the SGX Nifty. Coming back to global cues again, we've got some trade tensions brewing. China has scrapped the US farm tour, stoking pessimism of the trade deal talks. The delegation was supposed to visit the heartlands, the US farm heartlands, and they cut short their trip. Trump rejects the partial deal with China to resolve the trade war. He says that China's agri purchases are not enough for a deal. So that is probably the reason why the pessimism seeped in back into the US equity markets in Friday's session. Aside from that, now when you're looking at it, the big focus stays to be with the Indian equity markets and with what the Nifty 50 did on Friday's session. It surpassed all of its moving averages. In fact, I think it's missing out the 100-day moving average, but the 200-day big crucial 200-day moving average was surpassed. Exponential moving average as well as the daily simple moving average was taken down on Friday's session. The open interest across the board was a positive for the Nifty futures. Highest cash market turnover that we saw on an absolute basis. I think we saw closer to 87,000 crores in terms of the cash segment turnover. Now, ideally, that should have translated into a bigger FII number, but we'll come to that in a bit. Fresh momentum in autos, banks, real estate that may lend support to a further up move on the index. Short-term supply anticipated to come somewhere closer to 11,400 and 11,450. So we'll see how the Nifty sustains the move going forward from here. Coming to the September 26th open interest positions and how we are stacked up as well. You can see that 11,000 still holds the maximum amount of put concentration, while on the call side, it is shifted higher to 11,500. So the range is once again widened from 200 points to 500 points, and the upper end of that band gets pushed forward to about 11,500. Fund activity, FIIs were buyers, but just look at that number. It's only 36 odd crores, which probably, if you look into it, gives you a silver lining that they have to come in at some point or the other. And when they do come in, it's going to be a big number. Even if they weren't able to buy when the index soared 5.5%, and you just got a measly 36 crores coming in from the FII desk. DIs were buyers in a larger quantum. 3,000 plus crores is what they actually bought into in Friday's session. Some stocks to watch out for. You're going to be watching out for all of those hotel names as hotel room tariffs are starting to attract a lower GST, 12% from 18% in a tariff band of 1,001 to 7,500. Above 7,500, the band shifts lower to 18% from 28%. So stocks like Lemon Tree, Chalet, Indian Hotels, these are the names you're going to be watching out for. The big mover could be Petronet LNG. They're looking to sign an MOU with Tellurian to invest $2.5 billion in the Driftwood project in Louisiana for rights of up to 5 million tons of LNG per year. Now, two ways to look at it. One, obviously, given the size of the investment, it could have a slight bit of a negative impact on the operating cash flows and could create pressure on the balance sheet. But on the other hand, it will enable Petronet LNG to get gas at lower than $6 per MMBTU on a long-term basis, and there could be a substantial market and a demand for cheaper gas in India as well. So that could work its way around. The other stocks to watch out for. You've got Edelweiss, secured NCDs worth 50 crores, rated as BWRAA versus BWRAA plus, so a downgrade coming in from Brickwork Rating. Some bulk deals, Astral Polytech, HDFC MF has acquired 0.5% at a price of 960. The stock has been under pressure in the last week, not on Friday, but so far it was under pressure. The promoter has sold about 2.99% at about 962.48. Fundraising activity by Indian Overseas Bank raises 500 crores via Basel Street Tier 2 bonds. And Biocon, 4 observations of drug substance plant, 3 for the drug unit plant by the US FDA for its Bangalore unit. Sentimental negative, can see a short-term impact on the stock in today's session. So those are some of the stocks that you need to keep in mind as we step into trade this morning. But moving on, India cut corporate tax rates to bring it at par with global peers. What's more, the government removed increased surcharge applicable on capital gains made by FPIs. Is this enough to turn foreign investor sentiment back in favor of Indian markets? Let's ask veteran emerging markets investor Mark Mobius. He's joining in right now. Mark, thanks very much for taking out the time. Indian indices clocked the best one-day gains in over a decade on the back of the surprise corporate tax cuts announced by the finance minister. This is one of the biggest booster shots the industry has received so far. As a foreign investor, how do you read into these developments?
I read into it very positively because it's a great move, and it shows that the Modi government can take really aggressive, striking moves to improve the situation in India, and it's very good news.
Do you see corporate profitability improving significantly on the back of these tax savings? And would you then compare this to the time that corporate taxes in the US were cut from 35 to about 21%?
Well, you know, the impact in the US was very positive, and the same thing will happen in India, in my view. It will be very positive and will really give a big dose of optimism to the business community in India generally, and to foreign investors. So I think it's a tremendous move on the part of the government. Now what's needed is for them to follow up to clear away some of the bureaucratic hurdles that people have to invest, particularly for the small and medium-sized companies. If they can do that, that combination would be quite tremendous.
Does this call for an India re-rating according to you? The push is now strong and hard to make sure we are aligned with the other countries with similar tax structures?
I think it should call for a re-rating of India. I think, you know, a lot of people are concerned about, the budget may be too taxed and you'd have a big problem with the budget, for example, the deficit to GDP or whatever. But India is not in trouble in that regard. India's got a pretty strong financial situation as regards the government is concerned. And I believe also that government should be issuing large tranches of debt, government debt, to the international market. That is, I think, will help India a lot to improve infrastructure over the long term.
Do you see, because of this, a lot more foreign money finding its way back to Indian shores?
Definitely, because now it becomes a much more profitable enterprise if you go into India with these taxes being much less. You must remember that when foreign investors look at India, they compare India to Indonesia, Malaysia, and other countries around the world, but particularly in Asia. And now India is competitive as regards to taxation vis-a-vis these other countries.
Do you also see more money now being put to use to fuel capex in the private sector, and the additional levy that comes that companies now have, leeway that the companies now have, can be used to bring down prices to spur industry level volume growth?
Yes, that's one thing. But you must remember, it's not only a matter of cutting prices, but also increasing productivity. So now companies can invest more in more productive equipment and increased efficiencies in their manufacturing, which again will feed into prices, enabling them to reduce prices. So it's a sort of a double whammy, so to speak, as regards to prices.
You know, the finance minister also is giving a push to manufacturing. Do you think India can become and make its mark in the global manufacturing supply chain, Mark?
Definitely, there's tremendous opportunities for India. But India has to follow what the Chinese did, what the Koreans did, and all the other countries where they set up special export processing zones so that exporters could import raw materials for their processing and then export out into the greater world. That's what needs, more of that has to be done, enabling companies to come in and become very big manufacturers, because you must remember, India has got lots of labor, lots of skilled labor capable of doing excellent export work.
You know, we've spoken about all the positives. Does the impact of this in the fiscal, the stimulus on the fiscal math worry you? You know, you had earlier on in the past said that even if the government prints a fiscal deficit of 5%, it will not bother you a lot.
Yeah, that's what I feel. I don't think it's a worry. Because we must remember, now with this tax cut, you're going to see greater productivity, more production, more economic activity, which in turn will bring in more tax dollars. So, you know, the so-called Laffer curve comes into play here. I think it's going to be quite positive. And by the way, I think the central bank should be lowering rates in line with what other countries are doing. I don't think a lower rate will be detrimental to the Indian economy. It's very important to have not only lower taxes, but lower interest rates.
And in light of that, are you expecting the RBI to lockstep with other central banks in terms of the cuts to, you know, when it meets this October?
I hope so. I hope they get that message. And if they compare themselves to other countries around the world, particularly in the region, you'll note that Indian rates are high, and that shouldn't be the case. There's no reason why India can't do better in terms of lower interest rates, because it's a competitive world, and you're seeing that on a global scale, lower and lower interest rates.
Mark, will you be looking to increase your holding in Indian equities now? You know, is there comfort on the valuations now and a clear outlook on the earnings growth as well?
That's right. What I'm interested in is seeing companies do two things. One, increase their dividend payout, and number two, invest more in the business, invest more in labor-saving equipment, more efficiency, and greater application of new techniques to their manufacturing and their distribution.
And which sectors do you think you're going to be focusing on now?
We'll be focusing on manufacturing to begin with, because we believe that with the infrastructure spending that's going to be increasing in India, those companies that feed into the infrastructure spending will be very, very good. Consumer, as you know, we're always interested in the consumer. Per capita incomes are going up, so that's another area. And believe it or not, in the financial area, with this interest rate cut, hopefully a lot of the loan situations, bad loans, will be able to be paid back and solidified, and that will help the banking system as well.
Within the emerging market basket, where does India stand now post these announcements?
India stands pretty high. Up to now in our fund, China is a little higher than India, but now we may see India surpassing China. It depends on what opportunity we find in the Indian market.
Is China opening up its markets a deterrent to big money coming into India, according to you?
Not really. You must remember, China has not completely opened up the market. There's still a lot of restrictions on what can be done. And of course, the large cap stocks will benefit the most, because the large institutional investors will be the one that would be most allowed to enter the Chinese market. So it's a mixed bag. We're interested in the medium and smaller companies, and that's where there's going to be opportunities in India.
All right, one last question, Mark, before we let you go. Any major risks that you see in the medium term, which could, probably put a spanner in the works to the India growth story?
Yes, I mean, if the Modi government does not follow through on cutting bureaucracy and cutting the difficulties businesses, and particularly small and medium-sized businesses, have in doing business, then there could be a negative for the Indian economy.
All right, Mark, thank you so very much for joining us. Really appreciate you taking out the time. That's Mark Mobius there with his views. An incremental positive, yes, on all counts, and is probably saying that his exposure to India could surpass his exposure to China as well. And keeping it with the same theme, brokerages were quick to hike their target prices for the benchmark indices. The overarching theme, of course, would be the jump in corporate profits. Darshan Mehta, he's here to take us through the takeaways and which all brokerages have upped their target price.
At least 4 or 5 brokerages have upped their target. Let's start with the Goldman Sachs, which has raised the target price for the Nifty to 13,200 from the earlier 12,500. They're saying that the corporate tax growth cuts will revive growth for the economy. What they're also saying is that they're looking at investor revival in the investor sentiment, and they prefer domestic cyclicals over the exposures. Morgan Stanley's come out with a note. They've also raised the target price on the Sensex this time to 45,000 from the earlier 40,000. They're saying that this move creates room for improved earnings growth because all that flows into the bottom line. On the other side is the EPS growth, 25% for FY20 and 23% for FY21. The next few triggers, according to Morgan Stanley, for the markets to go to new highs will be rate cut, privatization, and increase in the FPI limit, and also in terms of sovereign bond issue. In terms of stock preference, what they're saying is that among the Indian stocks, they like mid caps over the large cap, and they like value over quality as well as momentum. UBS has also, raised the EPS for the Nifty by 8 to 10%. The revised base case is now 12,300 for the Nifty. The upside potential is 13,300, while the downside potential is 10,300. What they are saying is that there is some bit of concerns over the fiscal, but they believe that aggressive divestment will take this over. Nomura has also raised the target price to 12,554 for March 2020. They're saying there's a potential earnings increase of 7% for FY 2021, and Citi's raised the target price to 40,500 for the Sensex from the earlier 39,000, and they're saying that the boosters for the market is basically government announcements that would come in, and the markets are likely to expect more government announcements coming in.
All right, so quick to up their target prices there by brokerages, and it's a definite a no-brainer considering your immediate increase in profitability of most of the corporates. Darshan, thanks very much for that. The finance minister also announced that the government would not levy taxes on share buybacks announced before the budget was presented on July 5th. Yatin, he's standing by to tell us which companies stand to benefit from this move. Yatin, obviously, we had a few of these bigger names also that had announced pre-budget. How does this play out?
So, Devina, this is a two-part thing. Number one is, the cutoff date, which is 5th of July, wherein the finance minister presented the, budget, for FY20. More importantly, after the announcement which came in last week, there are a couple of companies which will gain to benefit, largely because of the tax shield that they will get, in terms of the buybacks, which were considered, as dividends, and hence a dividend distribution tax was effective from 5th of July. Now, the finance minister has said that 5th of July will be the cutoff. Previous to that, the announced buybacks, would get exemptions from the government with respect to the taxes which have been levied on buyback. So, the companies which purely benefit, those who have announced buyback but not yet initiated buyback. Number one being, Wellspun Corporation. Here, the total buyback size was close to 390 crores. Greaves Cotton, Sasken, Star Cement, Eris Life. These are the companies wherein the buyback size was over 100 crores. So clearly, all of these companies which will be, prima facie getting the benefits, since the board meeting to approve the buyback was in the month of June as well as in the month of July. Also, we had companies in the mid-cap space like SmartLink Holdings, Elegant Marbles, and as well as Vyapar Industries, smaller ones, but obviously they will save close to 18% of taxes as far as the entire buyback process was concerned, and hence this will be accretive to their overall cash on books. Of course, there are another large set of companies, the likes of Wipro, to 10,500 crore buyback, which has been recently concluded. So they save a whopping 1,800 crores in terms of the overall tax which they had to pay, but now will not be paying the taxes after the finance minister's clarification coming in. Adani Ports, last week the buyback concluded. They also would stand to benefit. And Bombay Stock Exchange, again, they had a very large buyback of over 13% of equity. The value was close to 460 crores, and they also stand to benefit since the tax liability will no more be an issue, and the money that will be saved, probably that is cash on the balance sheet, and clearly a big savings for all of these large companies.
All right, Yatin, thanks very much for that. So obviously a big positive even on the buyback front for most of these companies that announced buybacks prior to 5th of July. That was the day that the budget was announced. Well, we will slip into a short break, but some more big market conversations lined up on the show. Rahul Singh of Tata Mutual Fund on the market opening at about 9:15 a.m. and Prashant Jain of HDFC Asset Management at around 9:30. But after this break, a full tilt towards today's trade.